Hi, and welcome back to yet another exciting episode in Robin's School of Traders. In this episode, we'll be discussing about India VIX. We'll break many myths which are there in across the channels, and we can find a new friend while trading. Yes, you heard it right. We have to find a friend will help us to give us the range, the volatility, and how does it work. So there are many myths in this regarding this. So we'll break all the myth and let us see. So let's get started. So welcome back to Robin's School of Traders. This is what we do. We try to teach you to make rupees 3,000 to 4,000 on daily basis. So let's get started directly. What are going to be touch? We will be touching what is India VIX, how the formula looks like. It's very complicated by the way. How can we use this to calculate the daily range, weekly range, and yearly range? And intraday option, how can it help? And we keep on yelling and crying. How do we get the bottom and the tops? This is one of the best indicator to catch the bottom and the tops. Sounds exciting. So let's see. What is India VIX? India VIX is nothing. It just gives the volatility. So number one myth, it will never give a direction like Bollinger Band, ADX, YDX. So it is not is known that. It will give you the range of the volatility, and it's known by a typical name called fear factor in Indian market. Chicago Board of Option Chain was the first to introduce the volatility index for US market in 1993 based on their S&P 100 index option price. In 2003, the methodology was revised and new volatility index was based at S&P 500 index option. Since its inception, it has become an indicator of how market participation thinks about the volatility. Investor use the market volatility and the base the investment decision. So it's as simple as that. No rocket science into it. So what it will do? It will Indian VIX is calculated by National Stock Exchange from the order book of. This is what we're looking to add. Nifty option. It is based on the bid and asks and upcoming the following month expiry options contract. The value of VIX is derived by leveraging the Black-Scholes model. This measures the five variables of option contract: the strike price, the market price of the stock, the volatility, expiry time, and the risk factor. Nothing to get worried. Very complicated. I've given my head, but I was not able to crack the formula. Believe you guys, it looks very, very dangerous. So this is the formula it goes like. I've already shared the PDF. You go to the description box, you find the PDF. Those who are interested in this particular COB, Chicago Board of Option. So what it is saying, it is trying to find the volatility, how the fear is in the instrument by looking at the out of the money options. It's quite simple. When we get deep into it, we'll take it why a fund manager will hedge his fund when the market is volatile. That is you to understand. So will you try to see what are his importance? Let's go and see how does it look like. It is a wonderful lead. More the fear, and it has inversely correlated with Nifty. If this is moving up, the undoubtedly Nifty will come down. So if you see this on a daily time frame, uh, it looks so. We have a very strong base somewhere between 12 and 30. So this is the time you can put our the market has lost its volatility. This is the point market is cool, and options premium will be low. So here option bar. So what is the middle range? This is the range between 15 to 16 where it generally turns down. So you can use this as a tier one, tier two, where you can buy when the price has rocket bottom, you can buy, or you can use this as a tier three. So we will have only three tires to work. The first tire will be 12 when the market is settled down. So option you can buy, right? And tier two is this somewhere between 15 to 16. Sorry, my apologies, 16 to 17. Right. So this is the time we will be looking for 62 kind of low, RSI 30 kind of low, RSI 2 kind of low. We'll wait and find opportunity to buy. And this you will get in maybe three quarterly ones somewhere within 2021. Don't so if you have a fundamentals, if you are strong in the fundamentals of the stocks, this is the time you will be doing a blind buy when the VIX is sitting at somewhere between 20 and 20. So we have three layers where we can buy VIX as per your opportunity. Over when the VIX has shooted up from this level, so this is the time where option premium will be rocket high because FIDAs have to hedge their fund. They are not making money, so hence they have to liquidate, safeguard their principal by option hedging. So that is the root cause. When the VIX goes up, the option price goes up. Number one. Number two, why does it goes up? It goes up for geopolitical reasons, elections, new threat of wars, right? Pandemic, and I'm sure those who are long-term traders, they have seen the VIX tottering in the vicinity of 70 to 80, and this is the time we can make good profit. You should recall many days in option. You just buy into Corona days, buy a puts in the vicinity of 10, 12K, and tomorrow there's a circuit that put goes to 50, 70K. So that's the power of VIX. So we need to use this opportunity and let's see how can we make money. So the first thing first, when the VIX is cooled off, somewhere with 12 to 13, we expect a low volatility. Option buyer will make money. When the VIX is somewhere between 16 to 17, option premium will be high. But VIX shooted up in this last 3 quarters, I'm saying, sorry, last 3 to 4 months. It will again depending. It will all. This will depend on the time. So it doesn't have a rocket or ceiling kind of thing, right? So right now we are saying Nifty is range bound. So will be the VIX speed. So these are the three levels, zones they can use VIX to create. Guys, the best part is you can calculate tomorrow's range. Today's video which I'm making is 24th of December 2024. The formula is very simple. If you want to calculate the VIX, what is the estimated range of the market is going to be, which you can calculate it. It applies both for Nifty and Bank Nifty. So very simple. For a daily VIX, you have to calculate VIX, the current VIX. The day I'm making the video, the VIX is sitting at 13.18 divided by 63 and do a square root is coming to 19.1. And do this simple. Similarly, if you want to do a weekly VIX kind of thing, what is our Nifty would be in 52 in a week. So this is the formula and this is the yearly formula. It looks very simple. Now I did the same thing in Excel. As I said, when I'm making the video on 24th of December, the Nifty is setting at 2327. If you apply this particular formula, so this is the 26th range I'm getting. So I see a range of 160, 170 point in 26th market in an open set close, right? Obviously, this is not in consideration the cap up, gap down. This is not in consideration the global clues. But on an average, Nifty will oscillate somewhere between 162 points. So you can play and be accordingly. This is the range. What is the range, Robin? Nothing. So this plus, this is the percentage. This is the higher level getting what? This minus this is what you got the lower level. So similarly, I did the same for weekly. So on a week, the Nifty looks very strong somewhere between 41, for 24, 160 is the absolute figure. You can round it up. 24, 100 and it is a very strong support of 23, 200. This VIX can give you the range also in your daily, weekly and yearly. So same thing you can do with Bank Nifty. The video will shoot up to 25 minutes and I have discarded this for you. Now let's see how the chart looks like. This is the VIX and this is the Nifty, Indian Nifty, Nifty 50 and this is the VIX. In the morning, there was a huge, what do you call it? So VIX cooling off. So VIX cooling off and you can find some sort of correlation. This now let us see how does it work. Now we simply plot our VIX and this is where our interest comes. This is where interest comes. VIX going up is now put market will fall down. As simple as that. So how to trade this particular thing? You simply plot a VIX in one quadrant and in the money call and in the money put. You can find a absolute correlation. So what is the black line, Robin? Black line is nothing but just plotted EM and 9 as an reference point because VWAP will not be given in these three charts. Hence I had to plot VWAP. So lovely correlation. So you can understand in the market, weeks cooling off from a very high of from 15 to 13 kind. Now, how do you trade Robin Wicks? So the biggest problem, when you plot the Bollinger Band to find the range, we are trading volatility and using one more indicator called Bollinger Band. So we are working on volatility plus volatility. Robin, how do you trade? Now, if you look at this particular chart, it's very, very harsh to trade your Bollinger Band. Why? The VIX, obviously, there are option writer. There has to be unwinding, call winding, right? So, and put winding. So, it has to be unwinding. And in the unwinding, in crores or contracts has to be squared up. So, that's where the VIX are absolutely high and it can't be arrested. So, the third myth, which you say you can't trade this VIX with normal. We have to trade this in this some sort of form. Now, when you remove the candle, when you remove the wick, right, you wait the oscillation to come down. This is where it gives a meaningful data. So you're trading India VIX, you're trading your Nifty in one quadrant, and you're trading Bank Nifty in the quadrant. So this looks a lovely pattern, and this has a very, very high symmetry to the Nifty, how the Nifty, both the indexes works. So you can use this, which is one of the best settings which I personally use, and it works pretty well. And you can use this uh, in your intraday swing. Very simple. You can make a 2 by 2 quant, or in one quant you just plot Nifty VIX, Nifty, the mother index, the followed by VIX, and the next two quadrant you plot the in the money call and put. So it absolutely, the data will hit in the face. So this is a way you can make consistent money on daily basis with a simple information or fix. Only problem is that people are not aware how it works, and the complex itself is the formula. It's very, very complex. So that makes very tough. So there's no point going to the formula. It is simply taking care of the out of the money next month option expiry, and it is gauging where are the people willing to put money and how long they're going to stay, because option is related to the theta. So they absolutely they are playing the game of theta, or they're playing the game of time. So this is all about VIX. It needs 2 or 3 more videos to complete the entire chapter. It has a high correlation with implied volatility. You can make a huge money with this particular knowledge, but it's very harsh to compile all the things in 15 minutes. I'll make a series of it. The next series, I'll find the correlation of implied volatility and India VIX is a high correlation because we are looking for volatility, and that will give you an extra edge how to trade. Guys, I'm sure you must have liked the video. If you like the video, do subscribe to my channel. And if you have any query, do write to me or you can call me anytime. Thank you.